Good day, fellow investors. I was checking my Stocks to Buy 2024 playlist and there is more than 40 videos there, and I wish to review the key ones there. Also look at the performance from those 40 videos and see whether something is still a buy. Now, before we continue, I want to tell you that I do run a research platform, so my real buys are here on my research platform, and very few are discussed on YouTube because I have few buys because I am looking for more quality, and you can check that on my research platform. And there is a 21-day money-back guarantee, so check it out because it will give you context on, well, Stocks to Buy works good on YouTube as a title and what I really think Stocks to Buy are. So if you follow this channel, it's essential that you at least once check the research platform for 2 weeks to know what's going on, to give context to the risk and reward situations here and presented on my research platform. In other words, I'm giving you everything I do for free, so don't tell me that it costs this much or not. Then you see how it fits you, you can make an informed decision when you check it. And let's start immediately. December 2023, a company that I get asked a lot about is FMC stock to buy. The stock since the video I made is down 18.45%, but the dividend yield is high, the P ratio is just 4. That's incredible, but the key there is that maybe with Kennedy now, maybe there will be no seed oils, no pesticides, and that's definitely bad for FMC. Plus there is generic competition hitting the market early, inventory destocking on the food cycle, and that is why now the P ratio is just 4. Maybe the market expects more bad things going forward, but the numbers there are growing, net income is still okay, and okay, the cash flows are a little bit lower side, so 8% yield, free cash flow yield, that translates into a good dividend. But let's go to the earnings presentation and check what's going on with the company. The results look good, still growth there. There is some change in earnings, a little bit flat. If you look at the highlights, markets are starting to improve. So nothing wrong with FMC, will likely continue to pay the dividend. Revenue up also, everything looks good. The outlook there is a little bit more down, 12% decline in earnings, 2% decline in revenues. So the stocking and everything, high channel inventory will continue to create pricing pressures, lower prices. So it will be subdued, and then we'll have to also see about regulatory impacts going forward. The cash flows, okay, 400 million, that's already a 7% yield, so it is not that high. There is a debt issue, so slowly they want to repay the debt, but with high dividend it will take ages to repay the debt, but okay. And that is also the sensitivity of the dividend. Maybe the market is worrying about the cut. My wife would kill me if I would invest in a pesticides company, so it is risky. The free cash flow is used to pay the dividend, so it is necessary that the company keeps on producing that free cash flows. I'm not going to dig deeper, so I cannot tell you whether this, with a P ratio of 4, of course it looks like a buy. If they get up out of the slump and tariffs, they are mostly a global company, so the US might not hit them that hard, partially maybe. So from a fundamental perspective it looks okay. I haven't invested, I haven't looked into it, but all else equal, it still looks like a buy. The next one we discussed is Livent, and now shareholders are pushing the company not to be sold to Rio at a lower price than it merged with Alchem into Arcadium Lithium. We have discussed that more in detail into the lithium stocks, so you can check that on there. And for now, let's say flat on that. Maybe you can get a margin, maybe you can get some merger arbitrage on the Rio Tinto acquisition, but not more than that. Google then is saving my behind. The stock is up since I made the video. I made also some update videos now, so you can check the risk and reward that 44% up. Okay, Sven is at least doing something good here on YouTube. Nothing wrong with that. Another company that we checked was BYD. That one is also up even higher when you look at historical performance. I managed to make a timely video there, looked a little bit of what's going on, and as I said also in that video back then, a year ago, if they keep on growing, the stock will keep on growing, but I haven't looked into the risks and reward. Now the P ratio is 20, dividend yield is low, so I would not say it is a buy anymore. I'm in the plus from the calls. Okay, another company that is down 4% that I said was a good buy is Archer Daniels Midland. Made more videos about it over time. And when it comes to ADM, okay, it's down, but it is a dividend food stock. The food stock cycle, the food cycle can weaken still in 2025. I own ADM as a mid position in my diversified portfolio. As I said, for context, check the research platform. If it goes lower, I am ready to buy more, or it's a full position, sorry, for now. But if it goes lower, I'm ready to buy more. In the meantime, I get a 4% dividend, and that fits well a 17 stocks portfolio. It's not in my model portfolio. It's not personally owned yet. Even if it's a candidate, if it goes lower to the 40s, to the 30s, then it would get interesting for me. So for me, still a buy. We have discussed it more later, but okay. Interactive Brokers, I also said it was a relative buy there, and the stock did more than relatively well, really good. So again, 92% up. Now, of course, it is up. I think the price is higher, the risks are higher, and the returns are lower, so not a buy anymore, I would say, but okay. We also discussed other companies here, PayPal, and I told you that it is a bet, it can go up significantly, it did well. So in that line, it was not for me, that's all I was saying. WBD, Warner Bros, okay, did well since then. It is up a little bit, and now again, I'm always saying you have to see how these companies fit your portfolio. HP was also in that analysis. Not that good, but okay. From the free stocks to buy there, and then you have to see what company, what risk and reward fits you there. Warner Bros, HP, let's say an average of 15% there for performance. Talking about Warner Bros, just looking a little bit, okay, it started to rebound, but if I look at the cash flows, those are slowly and steadily declining despite what the company is doing. And with 2 billion of free cash flow per year, 2.5 maybe, it will still take a few years to pay down the huge leverage pile debt with 40 billion of gross debt, and they need to lower it to 20 billion to make it attractive to Wall Street, to give it a different valuation there, and that is the risk. They are doing whatever the company has promised over time, really doing well there, and that is already now reflected in the stock there, but you have to again see how it fits your portfolio. I'm not knowledgeable enough to give you more clarity there. ADM, then the stock went higher, it went higher, and that's exactly what I said here, 30 to 50% more upside. That is what happened. It didn't reach 75, it reached 65, then it went down again, but that is the stock market. From that perspective, I'm down 14.11%. More companies, I told you, my top stocks to buy, research platform, again, for reference, no risks, just upside, check it out with a money back guarantee. And this was made in March, April, May. I was buying Liberty Global and the stock was up 60-70%, now still up 50% because of a catalyst, because of a spin-off. So I'm putting 50% up on the research platform and you can check it, there is still good buys there. The next one, Starbucks. So we have Starbucks didn't do anything. Here it was a better buy, but then again, the P ratio is now relatively high, dividend yield okay, great brand, but I don't know how will these companies find themselves going forward. Another company that I discussed, CVS, it went down. Dividend yield, however, P ratio is still there. And I must say also something that we discussed with Ulta, with Dollar General, Walgreens. I don't know enough and I don't want to meddle into US retail going forward. Perhaps it will be a great buy on the cheap fundamentals, perhaps not, perhaps the fundamentals will deteriorate. I cannot help you much there with that. As always, that's also my added value, the risk and reward everywhere, and no projections, thus the risk and reward. Unilever, I again said, it is a good buy for a diversified dividend portfolio. The dividend yield is there. The stock did okay, 4%, and this is exactly the growth, the dividend, and that's the 7, 8, 9% return from a rational perspective that have been delivered. Same with McDonald's. It was relatively cheap back then, so I made a video there, better than most others out there. And okay, good return plus dividend. Okay, now I wouldn't buy it there. Then there were some discussions on stocks, no really projections, but just merely discussions. Ambev offers 3x potential stock to buy, and then I go into the risk and reward as always. Thank you for getting hooked on a stock to buy. The stock is down on the situation in Brazil, same risk and reward there, but you have to see how the dividend, the potential risk currency fit you. Discussing Nike, Intel, the risk and reward there, Nutrien and Mosaic that I just bought for the diversified portfolio, but mid position, ready to buy more if it goes lower. It is not going lower. In the meantime, I enjoy the dividend on that mid position, and so by having 17, 20 more perhaps position, we build a portfolio, we reinvest the dividends into the cheap opportunities. So it's always part of a strategy that I think can still be applied to these companies, but it's very hard to know what goes on there. And that's exactly what I want to discuss. Google, we made a value investing quadrant here, more updates, but the key message of the channel and the analysis I make, and even making the title stock to buy, that I always then discuss the risk and reward. The key is that you see how it fits you, the why, and that's also the problem on YouTube. I run a very concentrated portfolio for myself, then try to diversify, and I'm surprised that I found 17 stocks for my diversified portfolio. Nutrien, Mosaic, ADM are discussed here on YouTube, Rubis also, and then we build on those portfolios with those dividends, reinvesting should compound well over time. Some most recent companies that we discussed, Petrobras, again, just discussed the risk and reward, but it is a buy on that. If oil prices go up, the returns will be great. If oil prices go down, the returns will be uglier. That's a given. 9 stocks to buy, value quadrant, we discussed Treasuries, Berkshire, the ones I own, Samsung is getting interesting there, Petrobras more riskier. I wanted just to discuss a little bit here, check the quadrant video for the current situation, my current opinion on things, but as always, it is the risk and reward, and then performance is not really what matters when I do YouTube videos. And I get hundreds of comments, this aged like milk, this on a daily basis. And they give me just a laugh because the goal is not that. The goal is on YouTube, education, risk and reward, and maybe I'll put stocks to buy if the risk and reward is positive. And then you can see how it fits your portfolio, on what level of diversification, on what level of strategy. And that's what we try to do here. And there is a lot that we discuss. Some stocks will go up, some stocks will go down. But you have to see how what fits you, because at the end it is your money. And if you follow the channel more closely, then you know that, and I hope I give value. We are slowly reaching 250,000 of subscribers, so I will keep on doing what I do. And thank you for your feedback and your subscription, because that gives me confirmation that what I do also here on YouTube is good.